My special guest today is Giuseppe Stuto. Giuseppe is the managing partner and co-founder of 186 Ventures. Prior to co-founding 186 Ventures, Giuseppe was the founder and CEO at FAM. At FAM, he built one of the largest group video communities and was acquired by DraftKings. Giuseppe then joined Python Technology as COO to help triple the staffing and sustain rapid revenue expansion. At 186 Ventures, he spends the majority of his time meeting startups, performing diligence, and supporting portfolio companies and fund administration. Welcome to the show, Giuseppe.
Well, thank you, Andrew. I appreciate you having me and excited for our discussion today.
Yes, me too. Can you start by just telling our audience a little bit about your background? You've got this great operator background that is very authentic for startups, I'm sure relatable. Can you tell about that background and how that led you to start 186 Ventures?
Absolutely. Grew up around the Massachusetts area, just outside of Boston, most of my life. Was the first born in my entire family here in the United States. Most of my family still currently resides in Italy. Grew up from in a very diehard immigrant household. And went to school locally around the Boston area my entire life. And in my undergrad at BU, right around the advent of the App Store, which I believe was in '08, if I recall correctly, started to explore the world of mobile. And then close to my graduating year in 2011, started playing around with the technology at the time, trying to build stuff and so on, and all self taught for the most part. And shortly after my undergrad is when I founded my first software company in the group video conferencing space. So it was a series of iterations, but it was called FAM. I built it alongside two incredible co-founders who I always say they're the ones that really made the magic happen. And we built a multi-party video consumer experience within group iMessage chats. So there's obviously there were prior iterations that led us to this, but in short, we tried to solve the problem of how do younger generations at the time, Gen Z, want to share and express themselves, share what's important to themselves and express themselves. And at first, it was static based text content, and then that evolved to photo based static, and then video static, and then multi party synchronous video. And we figured out how to build a quality, scalable group FaceTime experience within iMessage before Apple had built anything of the sorts or any other OEMs. And over the course of 5 years, we built that company, sold it to DraftKings, to your point, in Q2 of 2018 after amassing a user base north of 7 million users with FAM.
Wow.
And then spent some time on the product and strategy teams, respectively, at DraftKings. And that's when I met my good friend Julian. We started to angel invest together in early 2019. And then, in your intro, you mentioned Python after being at DraftKings for some time and angel investing a bunch on the side, personally with Julian, joined one of those early angel investments, Python Technology, to help them scale the organization, among other things. Spent a couple of years there, and then going into the spring of 2021, we had amassed within the 186 Ventures brand name, we amassed a portfolio of about 31 early stage technology angel investments. And the at the time, Julian and I came to our respective inflection points within our career and thinking about what's next. And we looked at our track record, which was great. It was fine, and it was doing very well at the time, in a static snapshot. But I would argue a lot of people had good track records in 21 over the prior few years. What we really homed in on was the underlying problem, that there was a clear abundance of capital in the early stage market, specifically for pre-seed and seed investments. But the quality, for lack of a better word, of institutional grade support did not match that abundance of capital. And we saw this through our angel investing, where some of our founders, where we would write 25, 50K checks, some of our founders would say, wow, you're adding more value than the VC who invested a half a million or a million. And we're
Hmm.
like, well, that is not good. That really is what drove us to institutionalize 186. So our thesis was, and it's very consistent still, raise $30 million, target pre-seed and seed. We're going to focus on industries where we've built products or that we've already invested in great companies that have proven success, and now we have some competitive edge in those industries. And those are Web3 crypto, fintech, future of work, digital media, and digital health for the most part. There's also some others like property tech and so on. And we started raising in late July. We were oversubscribed by the fall with north of 30 million in commitments, and then we closed the entire fund by the end of 2021 with 37 million. But we had already been investing as of September of last year, so we have 10 investments under our belt today. And yeah, but that's kind of how I've gotten here. Kind of took the founder journey, tripped up a lot, had some success, and now translating that over to the investing side and trying to support founders well beyond just capital at the earliest of stages.
Yeah, it's a super authentic background. As a venture-backed startup myself at Intrinio, I can relate to someone who's actually scaled, who's had the challenges, been successful, and you've got this mission to be different, to fund companies but provide way more value, both strategic and tactically. Can you talk specifically, like, what can a VC do that, what do you do to add that extra value to help make your fund companies more successful that other VCs aren't doing? Like, what are you actually providing to these
Sure.
startups?
Sure. So, I'll answer your question directly, but I always like to, just out of respect for founders like yourself, when I'm asked a question like this, I always preface it with, to be clear, the investors do little to nothing, regardless of what investors market, regardless of what I tell founders or
Yeah.
any VC founders. And that is a bit of a fact. I know it's a bit of an anecdotally driven comment and opinion, but it's a fact. Now, there are certain things that investors can be equipped to do and do throughout certain points of the startup life cycle. At the pre-seed, at the seed stage, at the Series A and beyond, at the crossover, and even IPO stage. Now, what we're equipped to do, and we have done successfully, and we think we're on a relative basis very good at, is there's operational support and financial support. So on the operational support side of things, we've built companies before. We know what it's like to be an operator. We know what it's like to have to, bring in folks smarter than you and kind of figure stuff out on the fly, but still convince, industry grade executives that have been doing something for 30 more years than you have, why they should, put their entire families or their entire independent career trajectory on your shoulders. And that goes a long way because there's a lot of intangibles at the earliest of stages that go into hiring people, forming divisions, making product decisions, admitting when you're wrong, just knowing when it's okay to fail because you will fail. And we do all of that. We're on a texting basis with all of our founders. We've helped founders
Mm.
recruit senior executives. We've helped founders build out their people operation division earlier than they think they needed one. We've helped founders find board members when they need them down the line, and so on. And then on the financial side, obviously we write checks, but beyond that, we've institutionalized a bit of an engine internally where we spend a lot of time in our own passive time building relationships with other firms, whether they be other seed firms, more so Series A, Series B, mid stage, and late stage firms. We do it for a few reasons. A, because we want to learn from them. B, because we want to gather data points that are relevant to the industries that we invest in. And we package all that data up on a quarterly basis, and we help, hopefully, inform our founders' strategies based on actual benchmarks of what downstream investors are thinking about and how they're looking at the world. Because oftentimes that is relevant and important to consider when thinking about your financing strategy as a founder. So we do a lot of that, and it ends up saving our founders a ton of time because you know what it's like when you go out to raise, you spend 50% of your time gathering feedback.
Mhm.
And that 50% of time could be replaced with talking to more VCs, spending time with your team, instead of just trying to gather data points that honestly VCs who are on your cap table should be doing for you, right?
Right.
So I would say those are like the major ways that we have been helpful already to our founders. But and I always end with, because there's really no way of like showing this demonstrably, but we offer a humanized venture capital product. We are people, just like founders, and we know, if the going gets rough, we know when to lean in with good with hard advice, but at the same time also with just being empathetic. And sometimes the market's the market, and it doesn't matter how good of a founder you are, how bad of a founder you are. There's really nothing to do in some cases, and being just understanding of that goes a long way, especially because we're in the business of partnering with people. So even if founders don't figure it out on the first startup, we want to help them figure it out on the second one, right? If there's a mutual, quality relationship there.
Yeah, it makes total sense. You can, if you're following along at home, you can go to 186ventures.com and read some of these testimonials. That's all over the website. It's like proof in the pudding, of how you've actually helped these startups in a way that other venture capital funds haven't. I like the honesty that you're not going to cover chat support for me. I've had like all these years of covering chat support. That is like the hardest part of my business. And it's like, yeah, your VC isn't going to cover chat support for me, but you're going to tell me the future of the industry, where it's going. And we wasted time in our rounds talking to lots of folks and getting lots of feedback that maybe we didn't have to do if we'd been partnered with a firm like yours. So that is very, very relatable. You mentioned on your website, I mean, the company is named 186 Ventures, and it's right on your hero header on the landing page. Why you named it that is because the speed of light is set at 186,000 miles per hour. What is it, minute? But so what is it? What separates a startup that goes that fast from the other startups? Like, what are you looking for? You're going to provide all this value, but like, tell me a little bit more about what a startup that can go that fast does differently than a startup that kind of either fails or plods along.
So there's a series of things, and it's only appropriate and responsible to exercise some of these things at a very high velocity, like spend, hiring, growth, and growth. I'm doing quotation marks with my hands because growth can mean many things. But let's start with one that should never change, and that is the velocity at which you make decisions. Now, that does not mean not being thoughtful and taking the amount of time needed to make an informed decision, but thinking about in every aspect of your business, every division, depending on how big your business is, how quickly are we making decisions on when we were wrong,
Mm.
on when to go faster, on whatever else that you're doing, whether it's within the product organization, within the finance organization, marketing, or whatever, and even at the board level, right? And those things matter a lot. And we look for that in the fabric of the founders, in the fabric of the extended team, in the fabric of just the company's trajectory, not trajectory in the sense of just growing revenue, but trajectory at which it has changed. The best companies, best being defined as some of the industry changing ones, usually didn't have the same product that they had when they were at scale, right? Or the same solution or the same messaging in marketing to customers. And I'm willing to bet on all of them that they, on a relative basis, made very quick decisions to evolve and iterate, right? So that's really where what we mean when we say we like founders and companies that move at the speed of light. Now, we also like revenue that grows at the speed of light. We also
Yes, please.
like user bases that grow at the speed of light,
Yep.
but that's all relative, right? But one thing that's universal is the speed at which you're able to responsibly and thoughtfully make decisions, because that it shows a dedication to the craft and how much time you think about the problem you're trying to solve, whether it be the actual macro problem that your company's solving, or whether it be the latest debate within the engineering organization.
Yeah, it's like the decision making is the leading indicator, and the lagging indicator is the growth that comes out of
Sure.
making quick pivots. That's how you think about it. Yeah, I like that. Failing fast is a mantra, but like I think that a lot of companies, do you agree that a lot of companies stick with bad ideas because they don't make hard decisions quickly?
I do, because that was me once upon a
Mm,
time.
interesting.
that and I would argue, I mean, geez, a lot of people are guilty of that, right? It's how you learn. It's how I learned.
Mm.
I certainly was in that bucket at one point when I was a founder.
Can you tell me more about that? Like, can you remember some
Um,
things that you stuck with too long that you wish?
Absolutely.
Yeah.
Absolutely. I would say even just looking at FAM's trajectory. My co-founder Kevin wrote a fantastic article on the product iterations that we undertook over a 4-year period or so at the time. We're talking like 2016, 2015, whatever it was. And I don't think he time framed exactly when we would launch a new product or a new experiment. But if you look at, over the course of 3 years, through 4 years, we launched 5 different products. The first one being a very simple text-based crowdsourced solution for high school student news. The next one being an application that automated some of that. The next one being video broadcasting, and so on. The early on, we would kind of today we'd see the writing on the wall right away, maybe within a week or a month. And back then, maybe we spent 6 months on the first product. Then we probably spent 4 months on the next one, and then it would decrease and decrease and decrease, and the amount of time needed to kill a project would decrease. But if you look at it, the indicators at which we made decisions upon and why we would kill a certain project were the same throughout, right? So in hindsight, you're like, we could have made all these decisions in maybe a fraction of the time, right?
Right. Yeah, and that's very authentic. I mean, when you read the testimonials on your website, people talk about you, and you've got this background. You did this. You made these mistakes. You learned how to make the decisions, and now you're actually bringing that level of insight in. It's appealing as someone who's looked for investors before. Can do you think that companies who are trying to go fast and they're going for scale, like the Uber model, where you just you don't worry that you're profitable? Do you think they confuse going fast with not needing to make money or not needing to be profitable? And that's led to some of the startups that kind of the reckoning we're going through right now, where a lot of startups are failing.
Sure. So if I understand the question correctly, you're basically asking if whether or not founders conflate, when they're asked about profitability, they conflate it with kind of, if you go too fast, it kind of makes things a bit difficult.
Yeah.
Or sorry, can you frame the question?
Yeah, I'm wondering if founders got the message over the last 10 years, that we've really seen startups and unicorns and take off, that like it was more important to go fast than it was to be profitable. And that led
Oh,
them
sure.
yeah, if that led them to a lot of the problems you can see in the current economy of startups.
Sure. I think it depends. There's different buckets and categories of startups in why they face a reckoning
Mm,
when after going too quickly. There's ones where the model was the unit economics from early on were just not sustainable, right? Like some of these,
sure.
just some projects offering unrealistic yields, for example, on investing. This is more so in the crypto world, although there are some in the Web 2 world too. It's just not sustainable. And the unit economics, if you model it out and do some stress testing early on, even with when they have not many users, you'll find that even in some mediocre times, you're going to face some reckoning, and going too quickly on scaling that will get you into trouble. So you better think about those unit economics and how things perform in mediocre or downturns. And then I think there are other categories where companies move quickly. They know they have a sustainable model, but they're currently operating under unsustainable assumptions because of various external factors. Like, we strongly believe cost of capital is going to continue on and be at this level, and maybe it'll go slightly high, but not too much higher. So we're going to go gas on the pedal, and we're going to grow unsustainably because it's very important for us to build up that first mover advantage moat.
Mm,
And then, things change abruptly like they have over the last 60 days. And you have to put in place, a more conservative model that is sustainable, but at least you have that prepared. On the outside, you look at these companies and they're scaling back and you're like, wow, they made all these mistakes. But in reality is they were actually growing fast, but with a specific purpose and in
mm,
a thoughtful manner,
interesting.
knowing that there will have to tailor it back. So I think, yeah, it happens sometimes. And I think it needs to be used with discretion. I think Reid Hoffman and and Chris Ye wrote Blitzscaling. And I think there are just some companies that if they do not blitzscale, meaning if they do not grow in some cases unsustainably,
Sure.
they probably wouldn't be the industry leaders they are today, right? Uber, Airbnb being some of those examples where they just wouldn't have built up the moat needed to have whatever network effects or whatever enriches the customer experience to be able to offer the solution they offer.
Sure. That's a great answer because it depends, and it depends on how much thought you put into why you're not profitable. That is what really is the difference between a good startup strategy and a bad one.
Sure.
I think in my intro I read about you. It sounds like you're sitting around looking at doing your diligence on startups. That's half your day. Reading about new companies, places to invest. Can you tell me what trends you're noticing? I know things have changed dramatically because of the broader economy, but like as you're looking at potential investments for your portfolio and evaluating and thinking about startups, like what are you seeing come through the pipe?
Sure. So in terms of like categories of companies and
Yeah,
companies in general
yeah,
specifically, yeah, I would say we're seeing a ton. I mean, there's no doubt that regardless of downturn or continuing to grow and or whatever as a macro economy, that there are some problems within financial services that need solving. So the digitization of payments,
yeah,
we're in the early innings still. I mean, if you look at the penetration, if you look at Stripe and some of the others that have pioneered or at least are the trailblazers of digital payment processing, they still only kind of own a small percentage of the grander market of payment processing. I mean, it's so early. So I think solving a lot of those problems, we're still seeing a lot of companies innovating around payments, for example. We are still seeing a lot of companies innovating around lending, which is a hot topic because we're seeing a lot of lending related companies topple. But another thing that's undeniable are the tailwinds behind consumer credit. I think for better or worse, and I'm impartial, buy now, pay later is we've never had that option before. And we'll see if that leads to unprecedented levels of unsustainable credit for consumers, in which case there'll be, in some of these companies that we're seeing are kind of building solutions to really build around a world like that and service a world like that. Web3 enabled and crypto enabled projects, we're still seeing a ton of that on the infrastructure side. So, thinking about how do we, going back to a little bit of fintech, graduate some of our financial services and make them more higher performing, more cost effective. And then also, too, how do we build the infrastructure to allow these NFT communities to be able to offer actual real world value, aka be able to use NFTs maybe as a method of logging in and accessing certain products and services. And then we continue to see a lot of strong tailwinds and a lot of companies innovating in non-obvious spaces that are going to become very important with kind of where we're headed as an economy on a macro level. So whether they be supply chain infrastructure related enterprise companies, whether they be enterprise companies related to helping consumers resolve debt, and so on. And then, of course, digital health is will always continue to be a big trend.
yeah. We see in my industry, we're seeing a lot of fear, a lot of like funding is going to be hard to come by. But something you said a second ago struck me is that like the problems that startups can solve aren't gone because funding
Exactly.
has slowed down. So it sounds like there's no dearth of companies that are going to solve a really important problem that are still smart investments. Do you feel that way?
I I do. I do agree with you. I have somewhat strong opinions on this topic for the sake of helping founders, right? And really looking at things in a productive manner. So I think there's a couple of things going on. So you're right, and I don't think anyone can argue that the amount of problems that need to be solved are actually continuing to grow logarithmically. I think
Mm-hmm.
as we are clearly becoming a more technical world, and it is undeniable we need more technology, and that is why more and more people are driving towards building within software and other technology facets. Now, what I think is happening is two things happened, and I think that is why people are maybe a little misled in thinking about whether or not there's capital available. There's plenty of capital available, right? So if you're a founder building a product and you have real usage, real engagement, you will be able to raise capital. I mean, there's never been this much money on the sidelines for private technology companies.
Hmm.
Now, what is happening though, in why things are stalling out a bit for many founders looking to raise money, especially at the mid and late stage. I mean, from what I'm hearing, growth investors are just pens down. They're not writing any checks. And we're being thoughtful too. And although 186 we get in really early, we're thinking about companies that might be overpriced. Why? And this is what the problem is, and why funding has stalled, quote unquote, is because multiples were unsustainable. I
Hmm.
mean, what is happening? I mean, multiples. People were willing to pay certain multiples because inflation was helping drive a certain craze in the market, right? Now, as the Fed should, they're coming out, the central bank, and they're saying, "Hey, in the U.S., inflation it cannot sustain at this rate. We're going to leave behind multiple generations of people, and they can't even afford to buy things. Wages have only grown X%, but the cost of goods have grown X plus Y%. That just doesn't make sense." So now what is happening is everything's being repriced and coming down to reality, and multiples are a bit more realistic. And now, if you're a founder raising a seed round, and let's say you want to fetch a 20 or a 30 million post money valuation, which a year ago or even 6 months ago no one would have blinked an eye, investors like me are now saying, well, what is the real trajectory here? Because we have a fiduciary duty to our investors and our limited partners. We need to be able to, with a high degree of conviction, say, how is this investment going to appreciate in a certain amount of value? What is a big driver of that consideration, that assessment, is what are the later stage investors in my world thinking, and
Hmm.
how are they pricing things?
Right.
So Series A investors, if they're not willing to pay on average a higher price than a $50 million post money valuation, just an example, how can I invest? Depending on the market, every market's different, every company's different, but how can I invest at a 30 post if there isn't a reasonable amount of conviction that this company is growing at light speed, and the risk isn't as high as the typical seed company? Why? Because I'm not going to get for the amount of risk that I'm taking. There's not that much reward. You might as well just wait for the next round and just
Right.
pay a slightly higher price. So what's happening is, because a lot of the pricing is messed up, investors don't feel comfortable and responsible investing in some of the pricing. So the pricing hasn't recalibrated. Number one. Number two, this is tied to the second trend that I wanted to bring up, is the cost of talent. So founders, and they had to, were, I believe, raising more over the last 2 years because there's just a talent war. The cost of labor was increasing at a crazy rate, and the average cost for an engineer grew step functions higher
Hmm.
or than it did in
Yeah.
prior periods of time. So if you're a founder and you're at the seed stage and you need to recruit a team in San Francisco and Boston, or anywhere actually, you can't make buy with just 1.5 million. You need to raise 4 or 5 million, right? And that also starts to make the pricing mess up. Now, Bill Gurley from Benchmark actually had a great tweet storm yesterday or at some point this week that actually talks about how the cost of labor is going to probably start to come down to reality and where it was before, because companies just can't afford to pay what they were paying, and they don't need the amount of staffing they needed. So this is a good thing for early stage startups, but it also requires a rethinking in how much money you actually need.
Hmm.
So hopefully founders, and entrepreneurs or builders that are thinking about building a company, what we tell them is, you definitely need to raise what you need to, but don't raise more than you need to, because a lot of things are stabilizing. And if you raise more than you need to, you have to be willing to meet a certain bar of quality depending on the price you're asking for. The probability you're asking for a higher than average seed valuation if you're raising 4 million is much higher than the probability at which you're above average the seed valuation if you're only raising 2 million,
Right.
right? And those things matter, because time is your best friend as a founder. You need to get back to building the business. the more time you spend fundraising, especially at the seed stage, and I would argue even at the mid stage, is time that is actually making your odds of success lower, because ultimately it's still binary. So whether you give up 5% more or you don't give up 5% more, it's still a very binary formula.
Hmm. Yep. Wow. A lot there that I hadn't thought about, and I bet a lot of other founders haven't thought about. So it's good advice for startups. So would you say that with these compressing multiples where it's not as easy to raise at a high multiple, founders need to either like lower their expectations of how much they can raise, or just have better execution, be able to grow faster, solve a better problem. Is that how you'd summarize the advice to them? Is that they shouldn't,
Yes,
yeah, they need to,
I would say expect markets to be less forgiving.
mm,
If you are a true outlier in your growth and in your value, there's still a market
sure.
for crazy multiples. That will always be the case. I mean, there are companies even shortly after '08 that raised seed rounds at a 80 or $100 million post money valuation because they were that good. That will not go away, but just don't assume you're the outlier, right?
Mm,
And I think just looking back over the last 8 years, even from when I raised capital for the company that I had built and so on, years ago, it was I'd never seen a market like that a year ago, where every company could assume, and they should, if you're a founder, you want to maximize equity value,
yep.
would assume they're an outlier. But now it's no longer the case. You have to really be an outlier. So really just look yourself in the mirror and think, am I an outlier? And if you're not, you have to be very efficient with your capital and in your assumptions. You have to be very conservative, and or else you might get knocked down early.
Yeah, it's like there was unicorns everywhere all of a sudden. It's like, is that, I've got a unicorn hair sticking up on my head today. It's driving me crazy. It's got me thinking about unicorns. But yeah, I think that like I think a lot of startups have had to reset their thinking and be more realistic, and but also more focused on just operating and executing a solid business plan.
Right,
Instead of just being like, well, we'll just keep raising huge amounts of money all the time.
right.
And
And and to be clear, some of these things are really important because they do increase the probability that you will have a successful company.
yes.
So at the end of the day, a founder and an executive team should do whatever it takes to maximize enterprise value. And a lot of times, being more conservative actually lends to that better. For
Mm,
example, a lot of these companies, they might think, oh, well, I was able to raise an extra 10 or 20 million or an extra 2 or 3 million. And if it's a priced round, it's a higher price. You're giving options out to employees at a very high multiple. What's happening right now, a lot of companies that raise at these multi-billion-dollar valuations, a lot of their senior talent are leaving because they know it will take years to grow into that valuation at which
mm.
their equity was priced. So why will I wait 10 years to grow into this valuation when I can just walk across the street and get options that are priced a fraction of that and have a
Interesting.
ton more
Yes.
upside, right? So that's also a big component too
Yeah.
that founders need to think about. And one might say, well, safes, they'll be fine. You have to be careful. The IRS is getting a lot smarter about how they look at what options we're priced at. So, delaying, or delaying putting a fair price on options, or just trying to put a price on options that doesn't make sense, it only goes so far, right?
Yep.
So, yeah, a lot of things to think about if you're a founder.
Well, yeah, this is the nitty gritty that your website talks about the challenges you can help founders with is like how many founders are used to giving out stock options? Like that's just not something that you learn in college about
That's
like
true.
how to intelligently give out options to your team so they are motivated and they do stay. And I have never considered the idea that if your company can't outperform, the value of those options contracts, if you're inflating the valuation way too high, those options might never be worth anything. And so
Exactly.
this is something that your talent's probably thinking about that you might have just skipped over. Is that like, hey, we're going to maximize our valuation, and then people are not going to stick around to capitalize on those contracts because they just never are in the money.
I couldn't agree more. I agree.
Hmm. Interesting. That's good insights. I would be remiss if we didn't talk a little bit about Web3 because as we're recording this, it's June 16th, so the market is a scary place right now. And
Sure.
you've invested in some of these companies, and I'm sure you said you're evaluating lots of them. They're in your pipeline. Can you talk? I mean, I think a lot of the people who look at crypto and they just see Bitcoin and that's all they really know about might not know a lot of the potential in Web3. Can you talk about what your portfolio companies are doing, companies you're seeing, like where you think this should head, how this is going to change the world?
For sure. Try to be as succinct as possible. I could talk for hours on this, but I'll start with the last question. Crypto in taking a Web3 enabled approach can do a lot for this world. And the way that we like to think about it at 186, although we are not a crypto specific firm, we do spend a lot of time within crypto, and we do have multiple crypto slash Web3 enabled companies in our portfolio, in our fund portfolio, to be clear. And for financial services and for the world of media and entertainment, we think that the competitive edge of taking a Web3 enabled approach is unquestionable, and it's very high relative to taking a Web2 approach. So, for example, one of our companies, Ponto, they are leveraging crypto, stablecoin specifically, to be able to offer a more cost effective, higher performing cross border payment enterprise
Mhm.
grade solution, taking a regulatory first approach. So, a lot of large financial institutions, whether they be a bank or within some other industry, they have a lot of money that they need to settle internationally and even domestically that is currently using outdated financial rails, and it comes at a higher cost.
Mhm.
Companies like Ponto say, well, there are the more stable parts, truly stable parts of crypto that don't get as much attention that can be used to deliver a high enterprise grade financial solution. So that's one kind of tying actually every question you asked together, where we think by making cross-border payments more cost effective and higher performing, you're now, asking consumers who are sending money back home to spend less. So there's
Interesting.
then more money available to middle class families that are then able to buy other things. And it just helps the entire global system, assuming that you have good actors and well intentioned players building these technologies. And then within the world of media and entertainment, I mean, it's pretty self-explanatory. People deserve to be paid as much as they earn for the art or whatever they produce. And currently, depending on the platform, that's not the case. And fractionalizing ownership of this content that is produced and that generates revenue on a blockchain could actually lead to creators making more money and there being also a better user experience. So those are some of the areas where we think the world is changing in front of our eyes with the Web3 and crypto now. And that's one company, Ponta, that we invested in. There are others too that we've invested in that are also doing some incredible things. But to kind of make sure I have enough time to answer the other question related to kind of what do we think about the crypto world today and kind of what's happening. I mean, we think a lot of the setback right now is happening due to macro factors primarily. So rampant inflation,
Yep.
the Fed doing what it needs to do to fix inflation, and then of course to a lesser extent, because it is all connected, the unrealistic multiples that were applied to privates and public equities. And we think most of what's happening in crypto is due to that. Now, there obviously have been some serious setbacks related to some DeFi projects that were unsustainable, offering a lot of yield, and they couldn't really fulfill that. That causes pause for some people's confidence within the crypto world. But if you really think about it, those we're in the early stages of experimenting with this technology, and I'm not trying to excuse what some of these projects have done and the money that they've lost for their users, but more so from a macro standpoint, these are immaterial. I think in a 30-year trajectory, relatively immaterial causes or effects, excuse me, that if anything are healthy. They're going to teach the next generation of builders what not to do and how to responsibly use crypto to actually deliver real customer value. So it's never been a better time to build in crypto and Web3 if you're really delivering on a true use case that delivers real value relative to whatever the Web2 counterpart may be.
Yeah, it sounds like people are distracted right now by hacking, meltdowns, stablecoins that didn't work. But it's very easy for me to understand how, if you can reduce the cost of cross-border settlement, that's an insanely large value that is going to go at light speed. That's a great thing to invest in because it's a real problem with a great solution enabled by Web3. You don't just have to focus on the speculative parts of the market. Um,
Exactly. And also I'll give another example because it really ties in with what we were talking about. The reason why, because it's a very powerful statement I just made. Like, how can you look at these protocols with billions of dollars or once billions of dollars under management that went to zero um, within a week's time period be immaterial,
Yeah,
right?
material. Yeah.
And it's because what I'm seeing, and I guess this is from my point of view, so I'm not giving the full context, so I can understand why some people would find that to be an unfair statement. But I'm looking at what people are building, and one of our companies, for example, I won't say the name; it's not appropriate to yet, but they're in a bit of stealth. But one of the companies that we've invested in is building the financial governance operating system for DAOs to help them be more responsible with managing all of the capital that they end up with in their treasury. So not just cost accounting and helping pay, your workers and employees or collaborators more effectively, but also thinking about, okay, we have all of this money under management. How can we think about it in an institutional way, how to manage it? That's the solution. That's happening. It's just things have grown so quickly that didn't exist. Where you would have DAOs that have hundreds of millions under management within a few weeks' time, and they don't even have an accountant on staff. Never mind an industry grade chief
Right.
investment officer. They don't even have a bookkeeping. So
Yep.
of course this is going to happen, right? And I hate to say that, but it's what other outcome is possible when you have all those things occurring, right?
Yeah. Yeah. It's a great point and a level-headed point. And again, you've given me some insight. I didn't think about the perspective of not throwing the baby out with the bathwater in Web3, is that there's great technology out there, great solutions, and it's not all speculation. If you're smart and you really look into the project, these are real problems that are being solved. All right, I'll give you the last word. What's your advice to startups right now, current market, that are out there building? How can they stay focused on building a great company? What is your one piece of advice you'd share to these early stage or pre-seed companies that are listening today? How do you tell them to succeed?
A founder, regardless of what stage they're in within their lives, their most precious asset, and this goes for actually any human on this planet, is time. Respect your time and be real with yourself when it comes to what you're building and looking at indicators, both good and bad. If you see that the indicators on what you're building and hopefully you're shipping fast. So I guess number one is ship fast. If you have an idea, figure out whatever way possible, with or without technology, to test it, because there's always a fast way to test things and see how users or customers will respond and react to things, regardless of the industry you're building in. So that's number one. Number two, make fast decisions, kill things quickly, and be ruthless, absolutely ruthless in the results, good and bad, that you see within your experiments. And then number three, move fast when you see something working. And that means with thinking about what team is needed. If you're a solo founder, find co-founders. It's easier to just do it. I'm biased towards that. And don't aimlessly find co-founders. Find co-founders that balance you. If you already have two or three co-founders as part of the team, or you're a solo founder and you don't want co-founders, start thinking about how to build a team. And it's always best to build projects with people who you admire, who you have great relationships with. So spend a lot of time getting to know who you want to build stuff with. And be very thoughtful and realistic with your fundraising assumptions, because there's a lot of complicated things going on in the world that even the most founder friendly VC, like myself, I like to think, relative to others, still needs to take some time to make decisions. and in some cases cannot make decisions if things are a bit unrealistic because of what's going on in the world.
Wow. Fantastic advice. Check Giuseppe out at 186ventures.com. It was awesome having you on the show. Wonderful conversation. I really appreciate you being here.
Thank you, Andrew. Really appreciate the time.